Welcome to readtheticker.com. Today we're going to look at US dollar hedge through the eyes of a Richard Wyckoff cause and effect. Now, simply the cause and effect approach is where you have your base build up of accumulation. After a period of time, so much accumulation of the stock float or the futures have been accumulated, and then there's a breakout, and the effect normally can be considered a direct result of the cause, because you've got buying and selling, the debate going on here, and once the buying's been done, you get a breakout from the cause. It's called the effect. Just like a coiled spring, release of the spring. So whenever we see a strong cause of many ups and downs, we have to wonder what the effect would look like. Let's have a look around. Viewing the long-term charts, here's the US dollar. And the US dollar has a pretty powerful cycle around the 218 and 212 day mark. And as you can see here, we're expecting some sort of upswing. We got it. We got a downswing between here and there. But this most recent upswing didn't really show any strength, which is obviously weakness. If we expect an upswing and we don't get one, that means no one's really buying into it. Which obviously you have to ask, what's a downswing going to look like? If we do get a downswing coming up in the next year or two, we have to be a bit concerned because the upswing had nothing in it. So we had weakness in the upswing. The downswing just might be aggressive. That is a concern. If you look at the US dollar chart once again, but with channels, you'll see that we have a base building up. It's gone nowhere. It has been range bound. Been range bound for about 2 years at this level. Strong support at this level here. Unfortunately, the trend is down. Unless we get a momentum change to change our minds, we have to be pretty bearish on the US dollar. So folks out there will want to be hedging against a fall in the US dollar. One of the favourite securities or commodities to buy that has value, regardless of fiat currencies, is crude oil. Whoops. And here we have our cause. Quite a large cause, quite frankly. Whoops. It goes from 2010 to 2014, so we've got 4 years there. That's a pretty powerful cause. Fiddling around, hang on a second. And we're getting a bit of a strong pattern going on here. Now you would sort of think that you'd expect some sort of move. It could even take us close to $200 in oil per barrel. This is US light sweet. That's a pretty bullish pattern on the anti-dollar trade. Also concerned about inflation. Of course, one of the favourite trades out there against the falling US dollar is gold. Now, a lot of anti-gold folks have been calling pretty much this sell-off in gold pretty much a major crisis. Really? Look at this upswing here. And all we've really had is we had many years of upswing from 2001 to 2012, and we get a slight downswing, which is currently holding. So that's not too bad. Also, another metal showing very strong hedge against the US dollar. It's Palladium. And look at this cause. That is pretty powerful pattern, and you get the strong upswing here. That's your bullish setup, and now you've got your years of setting up a base. So the US dollar falls, you can bet your bottom dollar that it's going up there.